Would you like to learn a brand new and innovative way to invest your extra money that has a low barrier to entry and low competition? What if I told you that it is a guaranteed method to get up to 18 to 20% return on your investment? Tax lien and deed purchasing is the only way to get into the real estate market through the back door. No credit and no loans needed. This method isn't commonly taught, and therefore the competition is very low, for now. Put together a 14-hour info-packed course which will teach you everything you'll need to know to get started. Learn at your own pace, step-by-step guided video and aids to start you on the TLC deed investment process. The course offers many learning tools for new investors, helping ensure you safely invest in tax liens and deeds. Contact us today and join the buyback team.
Welcome to Secure Your Energy with your host, Lashley. Welcome all the primetime home buyers family and all of the real estate investors and people who just want to generally know or get an idea of what's going on in our current real estate market and everything that has to do with finance over here, okay? We're going to do this segment today. We're going to be focusing on the possible issues that we will be having in our mortgage sector. And this is in regards to foreclosures. So we did talk about actually, some other topics last week. And I want to say thank you for everyone who actually watched the videos, liked the videos, continue to share. This is part 2 to our primetime home buyers presentation or live that we do every Monday on primetime home buyers. Here we changed the tone a little bit. We're less formal, and we're not only talking about tax liens and tax deeds, but we're going to be talking about things that surround the actual investment market that can affect you. And one thing that I always say to the buyback team, we have to know what's going on around us for us to make the right decisions in regards to what states we're going to invest in, what areas are good, what areas are not, and what to expect with the market, especially when we are investors that want to do cultivating, we want to be landowners, we want to do land development. So you want to have an idea of what to look forward to. So today we're going to go into, is a repeat of the Great Recession looming? Okay, not a lot of people are talking about this. I've been looking for a lot of financial articles to see what I can find, and come to find out I didn't find a lot of information. But we're going to try our best to break down the information as much as possible for you today and with you. So we're going to get into an article that's brought to you by CBS, I believe, CBS News. Hold on one second. And this is highlighting home sales could plummet in 2023. Okay, so let's get started. Here, this is brought to you by CBSnews.com, and this article was December 1st, 2022. So we're trying to find as many up-to-date articles as possible. It's been really hard. Everything is pretty much couple of months ago saying, oh, don't worry about it. But we know a lot has changed, okay? Home sellers should brace themselves for a rough year ahead, with one real estate group forecasting that property sales could crumble in 2023 as more buyers are sidelined by rising mortgage rates and out-of-pocket home prices. The number of homes sold will likely plunge to 14.1 to 4.5 million homes, representing the lowest number of property transactions since 2012. And that's basically when we were coming out of the 2008 recession or hitting a plateau, when the U.S. was still recovering from the housing crashes and Great Recession, according to Realtor.com in 2003, as we just said. The pandemic triggered a massive boom in the real estate sale, bolstered by a combination of recorded low mortgage rate and work from home orders from many employees. Since earlier 2020, home prices have surged almost 40%, while mortgage rates have more than doubled since last year started. Double whammy that has the price many buyers out of the market. And I will say I agree with a lot of what they're saying here because we have seen this. If you own a conventional loan or home mortgage, as they may say, and you don't have a fixed interest rate, you may have suffered. This is why it's very important anytime you're going into a conventional loan to have a fixed interest rate, and then always try to, especially as a first time home buyers, go under the home buyers program because they have a lot of protections. The only thing that I do notice is with those first time home buyers program, you will be prompted to have extra insurance, okay? And that's just like an extra premium of $12, $13 on top of your payment, give or take. Okay. So basically, what ended up happening is that because there was a demand or the alleged need for more homes at the time of the pandemic, in which everybody lived somewhere, we just had to use it. And just what happens with capitalism, in my opinion, is that basically because we have a lot of capitalists in America, when they perceive that there is a need for something or they perceive that it is actually a demand, the price goes up. And that says a lot about our economy. And that's one of the things I always talk to my kids about because, as a homeschool mom, we talk about the economy and they ask, like, okay, so if someone needs more, why would they raise the price if more people want it? And I'm saying, and they like, isn't that greedy? And I tell my kids, yes, in the perspective it is because if you can have more people to buy something at a reasonable price, you will be able to make more of a profit and it will increase demands because people will be able to buy it. But people have the perception that the more people who can able to buy it, the less that is worth. And that's not always right, depending on what it is. And we do know that the value of something is based on the people perception. So let's get back to the article. Again, sellers may feel the burn of that impact next year, according to the new Realtors.com forecast. High home prices and mortgage rates will limit the pool of eligible home buyers in 2023. And that's what we were talking about, buyback team. We know a lot of people are locked out of the mortgage sector because of being unemployed, kicked out of a job because of the forced mandates, or transitioning because they felt like, hey, this is not the job for me. I'm tired of it. They also talked about the last 2 years being the great migration. So what that goes to say, um, that caused a lot of riff and raff in people's financial situations. So let's keep that in mind. Home sales are expected to drip the most in the California and Florida area. The biggest decline in sales volume will be in the cities, Realtor.com forecast. And I'm surprised that they said Florida. I know California, but the way things are going with Florida now and the laws and things that's moving around, I know a lot of people migrated to that area because of the feeling of freedom. But then, you have a lot going on with the educational system and a lot of riffraff and the politics that may make people uncomfortable. So we do look at places such as they're just basically focused on California and Florida. California, we know California has been the most notorious for a lot of mandates and regulations, which caused people to be very uncomfortable in the Florida area, moving out. There was also a law or a bill that was passed in the Florida area regarding doctors who was practicing out there. So doctors who didn't feel comfortable with that bill, they migrated out, which will cause more issues and more decline in the market out there. So they even go on to talk about Arizona with a negative 14.7%. So the highest on this list is Ventura, California, a decline of 29.1. So let's look at the bright side according to CBS News. If there's a bright side for sellers, is that the average sale price in the nation top 100 market is likely to increase next year by about 5.4%, according to Realtor. So it looks like the inflation is going to go up a little bit more. So if you have property already, you know, with my property, instead of me going to sell it, I opt to hold it, and I'm not going to give you any advice, but the reason why I will opt to hold it, if I don't have more than one property. Okay. Now I have one livable property and I have lands. And the reason why I will opt to hold my livable property because it may be hard to find another livable property within reasonable budget. People have tried to sell their homes, get into new homes, and it's just been an ordeal. They've been bidded out. They have not been able to find places. They've been living in Airbnbs, literally using all of their fundings, as what we saw in 2 weeks ago when we talked about the discrimination issue. And this may not even be a discrimination issue. It's literally because the big stake rollers are scooping up all the land. Okay. And this is why we do what we do on the buyback team. Okay. So it looks like we may see allegedly some more inflation, but you need to be prepared to make the right decision. So if you're a buyer and it's inflating, you need to know that you're going to have to come to the table with a little bit more money. As well as our tax lien and tax deed investors, this is something that you need to pay attention to. There's a fluctuation in taxes. So the taxes is going up in the areas as well based on the perceived inflation in the cost value of the homes. So let's keep that in mind as well. We expect for the year as a whole, 2003 is going to be a higher hell said. Shoppers who want to buy might have to wait a little bit. The elevated price will be more dramatic in some cities than other realtors can predict metro areas. That could be sharp increase are. We're talking about Massachusetts, Maine, Michigan, Rhode Island, Washington, Idaho, Tennessee, Indiana, Wisconsin. These are a lot of areas that we go into as far as tax lien and tax deed sales. So it's very important for you guys to follow us on our mother's channel, because if you feel like you're locked out of the industry, we definitely want to let you know that you are not locked out of the industry and that we are here for you to help you get into the tax lien and tax deed game. Okay. All right. So I know that a video came with this and I wanted you guys to watch it. So I'm going to allow you guys to watch the video. I want to make sure that y'all going to be able to hear it. I don't want any issues. And it looks like StreamYard is messing up my audience because I know we have a few audience members there. So I want to say, hey, thank you for being part of the stream. StreamYard is not showing how many people I have, but when I'm on my other pages, I can see we have people watching. So thank you so much. Now let's listen to this.
Mortgage dropped to 6.95%. Rates is driving up the cost of borrowing money on everything from car loans to home mortgages. Freddie Mac says the 30-year fixed mortgage dropped to 6.95%, but that's still more than double what it was just 1 year ago. And that means on a $400,000 loan, your monthly payments today would be more than $2,600. That's nearly $950 more compared to last year. CBS's Lilia Luciano has tonight's Money Watch.
Terry Arena just received an offer for her home well below asking price.
What concerns you as a seller?
That there aren't going to be as many people out there with the same buying power.
Home sales in this part of Long Island are down more than 22%. It's been happening all across the country over the last 8 months, the longest slump since the start of the housing crash in 2007.
And that's why I made that decision to put it on the market now, because if I wait till the spring, it definitely will be lower. So why not try now, even though the interest rates came up?
But her broker, Eric Stutz, says though prices are down, they're still way higher than before the pandemic.
What advice do you give? Sell now?
I think it's still a great time to sell now, but going forward, the market is definitely trending down, and I expect home prices to continue to drop well into next year.
That's because rising mortgage rates are shrinking the number of people who can get a loan and buy a home.
A lot of buyers have either dropped out of the market and are sitting on the sidelines. Some of them are even relocating.
Charlie Doherty at Wells Fargo says it's all by design.
Would you say that the housing market is just inevitable collateral damage to reduce inflation?
The Federal Reserve is cognizant of what's happening in the housing market, but they're willing to let the housing market go under a correction if that means inflation is going to come down.
Which means more cooling on a once hot housing market. Lilia Luciano, CBS News, Baldwin, New York.
All right, you heard it here. You heard it here.
Genetic.
You heard it here. Now, what he said was kind of a contradiction because he was like, yeah, it's good to sell, but it may not be easy to buy. So if you're selling, you need to make sure that you're going to have a place that you can rely on to actually go to have, because the market is ugly. Okay. As we talked about on Secure Your Energy when we were talking about getting prepared for hard times, cohabitating, those type of things. But what I am noticing is that there is a state, and we're going to talk about that next week, that is allegedly trying to do like some type of apartment emporium where you won't be able to have a certain amount of people in a dwelling. And this is typical as far as zoning for safety and things like that. But when they say you can only have two people in an apartment and you have a 3-bedroom, things like that, and or the cost of living is $3,000 and you only can have two people, yeah, we have some things going on. So we're going to be talking about that next week because there's some changes in the law that people should be paying attention to that can affect you. Okay, so then we're going to move on into another article, and this is brought to you by the New York Post. And this one was a little bit further back than December. This was actually September 7th. And this, it says the U.S. housing market declined to the worst in 2023, Goldman Sachs warned. So this is a update from Goldman Sachs, and they're going to be talking about what to expect because Goldman Sachs is connected to the big bankers that we talk about on our other channels. Now, U.S. housing market declined to the worst, worsen in 2023, Goldman Sachs warned. Now, the U.S. housing market has been slowing down in the past few months and interest rates continue to climb. Everybody's saying the same thing. But Goldman Sachs has warned prospective home sellers that the housing market downturn is expected to worsen in 2023, and for interested home buyers, this doesn't necessarily mean lower home prices. We expect home prices growth to stay completely averaging 0% in 2023. Now, if you don't understand the 0%, that's what's coming down from the Feds. And even if you get a 0% from the Feds or a negative interest rate from the Feds, that don't always trickle down to us. So what ended up happening is that these big companies who are receiving a zero interest rate, they go in and apply their status and start scooping up the homes. And I think this is what happened. They thought they were going to lower the interest rate, allow the big businesses to lower the interest rate for the middleman. But them big businesses said, hey, we can start buying up the properties and then we can rent it to them instead of having to sell all of them. So we have a lot of online platforms allegedly that actually have homes under their possession. And those are some of the topics that we're going to go into as well. We expect, Goldman Sachs strategist and economist Jan Hatzutz wrote in a memo to clients, while outright declines in the national home prices are possible and appears quite likely for some regions, large declines may seem unlikely. In the second quarter, home prices averaged $525,000. To compare, that's the average. That is a lot. Last year's second quarter average was $473,000, and in 2020 it was $374,000. Despite strategic predictions, a small decline in the home prices over the next year, prices are expected to remain high due to the inflation and the limited inventory of homes. Okay, so we're going to listen to this. Realtor Mike Arbery reacts to Goldman Sachs announcing housing downturn will worsen. Please bear with me. Got a little commercial. Don't want to bore you too much. I hope you guys are having a great night, and I hope you did. Let's go. Hold on. Just about to start talking.
On the economy front, which has not been too good for the President of the United States, particularly in housing, that's seeing a slowdown. If Goldman Sachs is right, we'll get even more tenuous next year. Also, mortgage applications just today hitting 22-year lows as buyers are starting to pull back. What's going on here, and for how long will it be going on? Mike Aubrey is the Executive Vice President, Principal of the Mike Aubrey Group, Berkshire Hathaway Home Services. So he knows of what he speaks. How bad is this housing situation? Because I don't liken it to, obviously, the meltdown we had more than a decade ago, more like an orderly retreat, but maybe it's more than that. What do you see going on?
You know, I think I have to look at what this word means, housing recession, because honestly, Neil, I'm not sure what it means. I can tell you what a recession is. I know that economists will tell you that that's 2 consecutive quarters of decline in GDP. But if you try to figure out what a housing recession is, really prior to this summer, you can't even find it searched on Google. I mean, I think what's happening right now is we're coming out of the craziest 2 years in housing that we've ever seen. And I think by comparison, everything would pale to really show us that we are getting back more to a normal and sustainable marketplace rather than seeing housing pull back. I mean, listen, I think that we've seen rates go up by almost 100% over a year. And obviously that's going to pump the brakes a little bit, but I think we needed to pump the brakes a little bit.
All right. He didn't say too much.
The thing that's different about a verbal vacation.
We're looking out over multiple years as equity investors, but absolutely next year still is critical. And what we've seen at the moment is just some tempering of that inflationary picture, which gives people some confidence that on the inflation print, on the terminal rates for fixed income markets, you can start to find some level that you can price equity markets. Now, I would say, evidently, the rally we've seen in the last few weeks does bed in a lot of positive optimism. And so we're seeing a little bit of a rollover of that as people start to get a little bit more concerned about the probability of soft landing. Maybe it's not 50-50, maybe it's a little bit weaker than that. But when we're looking at opportunities across the equity landscape, we still think that's more likely than not likely.
Your boss.
All right. He went into soft landing, and we were actually talking about the housing market. Anyway, so as you see, there's a little contradiction of what the other gentleman was saying in my eyes. But at the end of the day, 2 articles, that we went into is basically saying get ready because things may get a little bit more rougher. The market may inflate a little bit more while it's trying to allegedly correct itself. As well as if you are a seller, you may be able to, they said it's a good selling market, but it's not too much of a buying market. That doesn't make sense. So we need to keep that in consideration. If you don't have much buyers, who are you going to sell to? Are we going to continue to sell to the big companies who are actually inflating the market, as we just explained? The reason why we have an inflated market is because the Feds went down to 0%. We did not receive the 0%. We received 1 or 2, but it ended up causing the inflation to go up, in turn causing our inflation to go up, and the businesses or the big businesses to still, and I'm talking about big businesses, we're talking about realtor companies, we're talking about Goldman Sachs, these companies that backs the lenders, and then we have the Federal Reserve that backs the backers. Okay, we have to know the chain of command and how we fall. So we're like in fourth in line. So we have people right now up to 6%. My mine is at 4, which is a little high for me. My primary mortgage that I have on my first property, and I will say that I did see increase over the last 2 years compared to what they were saying. I'm going to say I'm blessed, and I hope a lot of you are blessed, because if you made the right decisions, which is one, if you're going to get into a home, you get into a fixed mortgage rate. You also want to get some insurance behind your mortgage, and if you can get into a buyer's program that's going to help you learn how to protect your actual investment. Meaning, one of the things you want to know is what the contract entails of, if it has an immediate buyout, or if it has immediate clause, a due on clause sale that we talk about. The due on clause sales can be any hiccup that happened, and then the mortgage company say, hey, you got to pay all of this right now. So you want to know if you have these clauses in your mortgages, because you don't want to get caught in a situation. And then you always want to have an open line of communication with them. So we're going to get into one more article as well. And we're going to go into the U.S. foreclosure activities continue to increase quarterly, nearly pre-pandemic levels, as he mentioned. And this was October 2022. Let me see. We got another one. We got one from January 12th, 2023. And this is from ATTOM Real Estate Trading Company. Okay, so foreclosure activity doubles annually, but still below pre-pandemic rate. So let's get into it. You guys, we want to make sure that you are being safe investors, okay? Because it's all about you being safe. Primetime home buyers buyback team, making the right decisions. I think I did the 2023. Let's move that. 22. Making the right decisions, because we need you guys to be well-rounded, because you're going to be the one to actually correct the market. It's going to be you. It's not going to be them. It's going to be you, okay, guys? It's going to be us that correct the market, the little guy, the one who get the property in their hand, and then we be human, and we actually have a rate that people can afford based on reality. I'm going to give this example. I went to a breakfast spot, one of my favorite breakfast spots, and I ordered an extra 2 strips of turkey bacon. And the extra 2 strips of turkey bacon was $2.99. And I said, for what? A whole pack of bacon? Oh, no, that's for the extra 2 strips. Inflation. That's not reality. And that's what we call capitalism and greed. And we have a lot of people in positions of businesses who have that mentality that we have to correct, guys. To my new business owners, the one who's coming in there to say, hey, we know what we need for everyone to thrive. We don't want socialism. We don't want people to just get free checks, but we want to be able to create a market that everyone can thrive. And that has to be built on not capitalism, not greed, and reality. So let's get into this article. The U.S. foreclosure activities doubled annually, but still below the pre-pandemic levels. And this is a January 12, 2023 article, the U.S. historic foreclosure activity and rates. So you're going to be able to see this. Let's see why I can't see the year. I think this is around 2028. I'm really thinking so. Let me see if I can get this picture being weird. All right, let's get into it. So ATTOM, a leading quarter of the real estate data nationwide for land and property data today, released its year-end 2020 U.S. foreclosure market report, which shows foreclosures, filing, default notice, scheduled auctions, and bank repossessions were reported on 324,237 U.S. properties in 2020. This is up 115% from 2021, but down 34% from 2019. They should not be. Why do they think that's a good comparison? Because 2019 was one of the worst years in the pandemic. I mean, I do apologize, in that foreclosure. I mean, that real estate crisis. I do apologize. So they're trying to compare our first year out of this pandemic to that. I'm not sure, because it wasn't the same market or the same issues. Okay. So before the pandemic shook up the market, foreclosure filings in 2022 was also down 89% from the peak, nearly 2.9 million in 2010. That is amazing. Those 324,237 properties with foreclosure filings in 2022 represents 0.23% of the U.S. housing unit, which is less than 1%, up slightly from 0.11% in 2001, but down 0.36% in 2019, and down from peak of 2.23% in 2010. So let's see how this goes. 18 months after the end of the government foreclosure memorandum, because that's where we're at, and with less than 5% of the 84 million borrowers who entered the CARES Act forbearance program remaining, foreclosure activities remain significantly lower than it was prior to the COVID-19 pandemic. Okay, they say, okay, I hope so. All right, so it seems clear that the government and the mortgage industry efforts during the pandemic, coupled with a strong economy, have helped prevent millions of unnecessary foreclosures. Okay, that is remarkably different from what we have been reading. So we really need to pay attention to this, because let's look at the trends, though. Let's look at the trends. Now, this was in 2005, and our housing crisis was in 2008. So do you see how many, and this was foreclosure filings between 2009, 2010, and they're trying to compare us to 2009. I guess because this is the time right after us coming out of the pandemic. I don't think that's a really good comparison. They may want to compare us to 2005 in my eyes, because me knowing statistics. But, we're just going over data here. We're just talking. So basically, they're comparing here to here. And I'm not totally sure if that's a great comparison, because right now we still have people trying to find their bearings. We still have the market correcting itself. We still have a great transition going on as far as careers in healthcare. It's a great transition. In transportation, it's a great transition. We're having issues in the farming sector. It's issues there. So there's a whole lot of other playing factors that actually contributes to this, because all those factors deal with someone needing a home and having to be able to pay for it, because everyone needs shelter. So we're going to keep our eye on this, because if you were paying attention at the beginning of the broadcast, from what we read from CBS News and the New York Post, it was remarkably different. And this is supposed to be really a credible representation of what's going on in our foreclosure market. So we're going to keep our eye on ATTOM. I'm not sure totally of their findings, but this is what the most up-to-date information I can find for you guys, the family, the buyback family, as of January 12, 2023. We want to make sure that you guys are making great decisions, not just being safe tax lien and tax deed investors, doing your research, doing your due diligence. This is part of your decision making. Even if you are buying a conventional home through a loan, you want to know the market. You want to understand the contract that you're getting into. You want to understand if these companies are able to do predatory lending to you. And as we mentioned, when Trump was in office, one of the things that he did was defund the Dodd-Frank Act. And this lowered the regulation practices against big business companies and mortgage companies. And a lot of things has happened over the last 2 years that I've noticed. And I'm not blaming it on Trump, but when bills and things are changed, you get to see the influx of what happens a year or two. And I know you guys have noticed there's been a big influx of scams. I'm from Georgia, and I'm going to tell you it's terrible. And even from outside of the country, I'm noticing that I'm having to fight scams all over the place, guys. You guys, please be careful. I promise you, from receiving fake bills from Hertz, because Hertz, got sued recently from doing fraudulent practices, but they still functioning. And we're talking about Hertz car rental. They're still functioning. They just filed bankruptcy and they come back. They took a trip off the old block. But now we're suffering because Hertz is doing things like filing fake bills. And I have proof because that was one of the things that happened to me. Also, let me give you another heads up of some things that's going on. You have people from outside the country who somehow are able to tap in to a lot of our systems. I don't know where's this happening, but maybe because this was my first desktop. I just want to get off a subject today because I want to talk a little bit about scams, because there's a lot of scams going on too. And there's a lot of mortgage scams. So we're going to have to talk about that as well. But what actually ended up happening, I went to upload on my computer and all of a sudden, I got a note said, don't touch nothing. Call Microsoft. We are experiencing someone is trying to hack into your computer. And it was God be the glory that I was already aware of a scam like this. So I was like, wait a minute. No way. Microsoft don't do that based on what I've learned. So I need you guys to know. I called the number, even though they say never call the number. I called the number. And I told her a little bit about herself. And she was like, well, if you think it's a scam, why you call back? I said, because I want to let you know that Americans, we're not stupid. We're not fucking stupid. And you cannot do that. You're not going to just break into our computer and think you're going to get hundreds of dollars from us when we can just click your ass right off of the screen. Excuse my language. So guys, please be aware that there's a lot of schemes going on these days. And there's not only just in real estate, because we're going to get into that. I'm talking about all over the board. That Dodd-Frank Act has unleashed the monster in people. So look at this chart. We're going to share these links definitely by tomorrow morning. I want you guys to look at these charts and see what's going on, because something is a little weird. Okay. All right. So the leading culture of the real estate nations that we talk about for land and property data today released. This was the year and date. At ATTOM, they're the leading quarter of the real estate data. And this, I don't know. So let's get into one more article before we get off tonight, because I just want you guys to just be well-rounded buyback team. I want you guys to realize the market you're in before you go just jump into a property, okay? So we're going to get into foreclosures are surging. Is it a repeat of the Great Recession looming? Okay, this is going to be our last article for tonight. You guys have been amazing. I want to say thank you for stopping by today to expand your horizons, to learn outside of what is the typical for our community. You know, they keep us very distracted. And if it ain't about celebrities and things, we kind of don't worry. But we have to, because we are the bread and butter of the nation. We are the top spenders. And we need to know when and how to spend our money. And the only way that we're going to do this is by educating ourselves. So this will be our last article that we're getting in today. Foreclosures are surging. Is it a repeat of the Great Recession looming? In November, 3,677 reported properties across the nation received some sort of foreclosure filing, such as a notice of default because the homeowner is behind on a mortgage payment, or an auction schedule, according to the recent report from the real estate data from ATTOM. You see what I'm saying? But when they summed it up, it sounds different. But when other people take the data, they saying something different, guys. So that's why we always got to read and compare and contrast so we can get our own perspective. That was up 57% compared to a year ago. Okay. We are 3,770 completed foreclosure during the month, up 64% versus last year. While such big spikes might seem jarring, it is not a sign of another foreclosure crisis about to hit. During the COVID-19 pandemic, there were foreclosure memorandums put in place for those with government-backed mortgages for nearly 2 years. Many lenders extended these protections to our borrowers as well to protect homeowners who lost jobs or other income during the pandemic. The result is a higher number of foreclosure filings now because proceedings are going forward again, but foreclosures are still lower than in the pre-pandemic, allegedly. ATTOM, Executive Vice President of Market Research, says that it will take until the middle of 2023 for the foreclosure activity to reach pre-pandemic levels. Even then, it should represent a corner of the overall housing market, a big relief for anyone who remembers the foreclosure crisis in a decade ago. There's no doubt that loan quality today is far superior compared to loans and defaults and triggers the home market meltdown. So they're saying that because there are lending stipulations in price that were for all these years, it should create a buffer, meaning that they have more people who are honorable, who are not trying to default. But when you're in the situation, you never know what's going to happen. So mortgage delinquencies are still lower than the historical average, the ATTOM report note, and job markets are still strong. Okay, so this is some of the talk for this year coming up in the housing market. Please, guys, let's pay attention to what's going on. We never know what's going to happen. We can read this, we can listen, but you have to have discernment. Okay, make the right decisions, spending wisely, saving, budgeting, saving on electricity, not splurging, because you may want to have a buffer. You may want to have a little bit more because of the increase of inflation and what may come. Okay. Also, you never know. You may have family members who may need to stay with you. You want to be prepared. Cohabitation may be something that may help too, as well, to help you buffer those extra bills and inflation. Okay. So I just want to say you guys has been amazing today. I want to say thank you for being part of the buyback team. This is our sister channel where we talk about topics that are adjacent to tax liens and tax deed sales, but things that you need to know to make the proper decision as a tax lien, a tax deed investor, or a real estate investor. The market is changing and we need to be aware. Please review the video, and I'm going to put the links to the articles so you can compare and contrast, because we can be looking at the same data allegedly and people pull out what they want to pull out. So we need you to pull out what you need to know about your state, the mortgage rates, the foreclosure rates, what homes are available, what type of home, what areas, especially if this is a state of interest as a tax lien investor. Even though we're coming in unsubordinated from the loans companies as tax lien and deed investors, it's a beautiful position, but we still have to understand how much taxes we may have to pay, what insurance rates is going to be, how much it's going to cost to build on the property, and things like that, and the change of laws that is accompanying all of these changes in economy. So again, I want to say thank you so much for being with Lashley today. You guys are amazing for allowing us to elevate the conversation, making sure the Black community are aware of what's going on so we can get prepared and be part of the elevation of the economy. We don't want to be just the backbone of the economy. We want to elevate it, be able to control the rates and things to that nature. And the only way we're going to do that is by owning property, owning land. And as you see, some of us are locked out of the market. This is why you're a part of the buyback team. Thank you so much for being with us tonight.
Would you like to learn a brand new and innovative way to invest your extra money that has a low barrier to entry and low competition? What if I told you that it is a guaranteed method to get up to 18 to 20% return on your investment? Tax lien and deed purchasing is the only way to get into the real estate market through the back door. No credit and no loans needed. This method isn't commonly taught, and therefore the competition is very low, for now. Put together a 14-hour info-packed course which will teach you everything you'll need to know to get started. Learn at your own pace, step-by-step guided video and aids to start you on the TLC deed investment process. The course offers many learning tools for new investors, helping ensure you safely invest in tax liens and deeds. Contact us today and join the buyback team.